To borrow from a topic that's been in the news, obviously lately, especially those living through it there in the West, the Florida Panhandle, in Florida and Alabama, Georgia, having gone through that hurricane. Well, from a metaphorical standpoint, today seemed like the eye of the storm after the big winds at the end of last week of volatility and potential winds of volatility coming up this week with earnings afloat. So on Monday of all days, when there's not a whole lot to announce, we get a little bit of a calm. So what's going to happen the rest of this week? What can we expect? That's what I break down in this video, as well as a trade idea to help balance out some of the other trades that we've been looking at in previous market outlook videos. So let's go ahead and get started. Today is Monday, October the 15th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching us for the very first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click that logo right there. Then click the red subscribe button that pops out. That will get you notified every time we produce these videos day in and day out. Also, click the thumbs up icon that's down below the video. That tells me that you got something out of the video tonight, and it tells me when you click that thumbs up that you want me to do it again tomorrow. Really easy way to give me feedback. You can do that right now while you're watching. Comment on the video tonight. Comment on what you get out of it. Comment on any questions you have or any comments you have about things we talked about. You have to scroll down below to do that. Follow me on Twitter for more content like this throughout the day. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link up there to subscribe. Finally, join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 with the market forecast first. You can see that intermediate line is still in that lower reversal zone. Again, in February, it got down there just briefly on that down day. That's how far up we were to have this be the first day right here where it drops below 20. And then over here we had, again, the subsequent bounce and reversal from a much lower high point, and barely above the moving average at that point. And you can see, these are the days that the intermediate line got down below 50. So not too often that we get the intermediate line, below 20. And that's where we're at right now. And we have, for the last few days, kind of triangling into a pennant formation. This actual pennant formation, if you just, I know we've been talking about the possibility of a bounce, but if you just look at the pattern itself suggests a move coming out of it that you had coming into it. That's the typical expectation, of course. A lot of other factors, but if that's the only one you look at, you would expect a big move to the downside relatively quickly, considering how we're forming this little triangle here over the last few days. You'll see that better on the intraday chart. You see the near-term line bounced higher, and again, that's what we're watching, right? Is that the next peak on the near-term line. Once it peaks above 50, then it's on, right? Then it's on. Now it's a matter of where is it going to peak? Is it going to peak below 80 or above 80? And then how long does it stay above 50? What you need to establish a new intermediate bullish trend, which, again, would have to, the intermediate line not only have to turn up, but it have to get back above 20. That's when it's bullish again. Weak bullish, but still bullish. For it to do that, you need, the blue line to peak above 80, and when it does get above 50 first, right? And then to stay above 50 in the upper half of the chart for 7 to 12 days, preferably closer to 12 days. And if you can get an oversold cluster within that time frame, all the better. And most unlikely, because of how far the intermediate line has to rally to get into the upper reversal zone. Those are more likely when you're coming up off of these kind of quote-unquote phantom green arrows where the intermediate line turns up without getting below 20. Gets below 50, but then turns up much quicker. That's when it's easier to get the clusters at that point. So you have a strong bearish posture right now according to the intermediate line. The near-term line's bouncing. The question is, are you going to break out of this triangle and get up above 2,800 again? Like a 1 week fail breakdown below 2,800 and then get back up above it? Or are we going to hold 2,800 and stay below it and then start to threaten 2,700, which is your next layer of major support level. All right, so if you take a look at the Dow Jones, same triangle pattern. It's called a pennant formation that's forming here again. The typical pennant formation is a big move in any direction, up or down. In this case, down. Then you have a small falling ranges that are all kind of triangulating here over a matter of a few periods. And this is a daily chart, so it'd be over a few days. These can happen on weekly charts, on hourly charts, whatever the period is. The idea is a few periods only, and then again the expectation is you break out of that pattern in the same direction that you came into it. Again, with big moves, right? Similar size big moves. So we'll see if that ends up being the case. Again, there's support levels for a lot of these major indexes that would suggest that based on what we talked about Friday that we'd bounce up to the upside. So we'll continue to see, of course, on the Russell, on the Dow, you have to get back up above 25,500 to feel better about the bounce. The near-term line, so that's the Dow. The near-term line for the Nasdaq is above 50, so it's still forming a pennant too, but its near-term line has bounced up higher, coming off of a couple of clusters in a row, oversold clusters in a row. You can kind of see you need to get above that 7,600, the halfway mark of that point. And then finally the Russell 2000, which got 4 clusters in a row, is not getting one today. The short-term line's bouncing up again. Where is that near-term line going to peak? Is it going to get above 50? Considering how bearish it's been, probably not as likely to get above 80 on this first near-term run. More than likely, you might dip your toe above 80, but then come back below 50 and form a bullish near-term low point, right? Where the next low on the near-term line will be higher than this one, and then you'll bounce off of that. That will give you the better chance for that bullish near-term high that you're looking for. That will get the intermediate lines, excuse me, the intermediate line to get back up above 50 again. And just kind of show you again how bearish we are now. We didn't get, so there's that February drop. This was actually much smaller in small caps because again a lot of that was focused on trade and yields, and so I had a far less, and small caps weren't nearly as bullish going into it. The income taxes and things like that benefiting large cap stocks more than small cap stocks. But you can see here, it's been a while since we've had the near-term line below, the intermediate line below 20 for this long. It was really the August of 2017 right there that we were this bearish for this long. Again, the near-term line dropping, and really it was the election was the other time that we were this bearish for this long on the intermediate line, without being again below, without having the death cross on the long-term chart. All right, before we look at some other charts, I did want to say thank you for the likes here on the tweet, on the Market Outlook tweet, on the Facebook post, on the blog. Those are the 3 clicks we asked for. That's what we look to see, do they want us to keep doing these videos? We look at it every day to see what you're thinking, what your feedback is for us. Also, I hit a new record here. 53 shares is the biggest I've seen. So that's you all sharing our content across these platforms there. Keep doing that. I'd love to see. The goal for us is to get to 100. So 53 is actually a new high, eclipsing the old high of 52. So appreciate that. Also, a quick note here too. Remember, any upcoming events, these are all actually my classes this week because Brandon is off on vacation. So make note of that. There is no. You might be like, where's that? Where's the dividend growth investing class? That's usually tomorrow morning, Tuesday morning. He's on vacation, so that's why it's not there. So all of my classes are posted over here on the right, and of course you can click on that view more to see more of our class schedule. Speaking of that long-term chart, here's that big drop, and you see we don't have that death cross yet where the 50-day crosses below the 200-day. You can see we are still holding the 200-day on the S&P 500. The Dow, we're actually still quite a bit above it. And then there's your NASDAQ also holding the 200-day moving averages after these pullbacks. And we've seen these types of moves before. We saw it earlier this year, especially in February and then in March. We bounced off of those times, and we'll see if this 200-day ends up holding. Remember that 2700 is kind of your next layer of important support level for the S&P that you would expect again to hold, obviously until it doesn't, right? Here's your 3 green arrow chart. Obviously we have 3 red arrows, and as I mentioned to you on Friday, the MACD on an absolute basis is very low. It's even lower now. Again, about as low as we were in February. When you're this far away from these moving averages, it's hard to keep going further below them. The moving averages are dropping, so usually that's a time for this would be a divergence, right? MACD stands for moving average convergence divergence. This would be a divergence, and usually when you get a convergence right afterwards, on bullish charts, convergences tend to be more gradual. On bearish divergences, they tend to come up pretty sharply. You can see every time we converge from these low levels, we came up pretty sharply off of that. So again, don't expect us to start to go sideways here and for these lines to eventually catch up. We can now, of course, we can definitely form a bullish divergence, which means we go to lower lows, maybe even to 2700 on a short-term bounce, and then a move down to 2700 to test that support, in which case you'd have most likely a bullish divergence setting up. So that possibility is always there before you get that convergence back to the upside, which remember is typically always a lot sharper to the upside than the convergences are to the downside. Like, they tend to be a lot more gradual. Now let's take a look at the intraday chart here. Here we go. Another inside day today. We did test the highs and you can see the lows have been gradually getting higher until that last little late sell-off at the end of the day, down to the lows of the day. Kind of some bearish news on Apple weighing on the broad market as a whole. Still within, though, the range from yesterday. So inside day Friday, and then another inside day today as we are really going sideways. Again, you can see the important intraday level here, 277, that you got to get up above before you can say, okay, we're making a reversal. Now, any reversal to the upside, you're still going to hit some resistance in this 282 area. So keep that in mind. And of course, there's the open here to this week's Heikin-Ashi candle. So if you're going to be bullish this week, you're going to get signs of a bullish turnaround, you got to get up above that high point. So most likely that's probably not going to occur this week. If we do get a bounce up and close higher by the end of this week, you'll probably be into this area here. Probably be about as high as you get now, with some ups and downs, but that would be kind of the expectation. You do see here's this data point in the last 10 years or so. There's been 4% moves in the market 15 times. On average, the market's up 2.5% over the next week 12 times. So that would be by the end of this Friday. So if you say, okay, well, where's 2.5%? Here, let's do this expansion here a little bit more. And you say, okay, where is? I need to go more than that, don't I? Because we're not on a daily chart here. Let's go. There we go. So we'll go 2.5% from close on Friday all the way up to Friday here, which is options expiration. That would be 2.5% right about there. That's all it would take to be up 2.5% this week on average, right? So of course that'd be over the the 5 trading days today, this week, and it'd be by options expiration. So if you were to get even a move up into this, even to that midpoint, that'd be a 5% move on the week. So don't expect to close up here. We could, because anything can happen. Volatility is relatively high, but like I said, the average is 2.5 roughly. That gets you right about the 280 is where you'd be looking, roughly 280, a little bit, 279 looks like. That's not very far away, especially considering that'd be now 5 points away from where we're currently at to get to that level. One benefit to today's move, even if it didn't bounce, was it was a much smaller range. So now back below the average. The average has gotten much bigger. In fact, it's pretty much doubled. But now we're back to below the average, so 2.74. The volume is also just a smidgen above average. After 3 really strong days, more than 1.5 times, we're now back to 102. So when you put that in context here, 102 million shares traded is right here after a few days up in this area. So that's a better move there. And then you can see 2.74 points is below that average now. And obviously that would be about 1% relative to the current price. So that's a good sign that you're finally getting a small. Now, granted, if we bounce with this volatility as high as it is, we will most, because it's still relatively extreme. It's close to that extreme mark to the upside. It has pulled back, but it's still at that 1.05 mark. I expect big moves up and down. We just got quiet. There's not very much news today that impacts financial markets, so we didn't get very much movement. But volatility, until that volatility gets back into this neutral range, expect big ups and downs, even if by the end of the week, if we hit that average, it doesn't look like it's up very much. But with volatility as high as it is and still above 20, that means much bigger moves than what you saw when volatility was below 15 for most of this past month. So to summarize, the markets are strongly bearish according to where the intermediate line is, but still holding long-term support levels, still holding long-term trends. And so the question is now, what's this next bounce, short-term bounce, going to look like? More than likely, the next short-term bounce is not going to be a bullish high. We'd have a long ways to go to get to the last short-term high point. So most likely will form is a lower high, even if that near-term line gets above 80. But getting above 80 will be a good sign for that blue line again in the market forecast. And then it's that subsequent near-term low point. Is it going to be higher than the previous low on the chart? Is it going to be above 20 and only spend a day or 2 or 3 below 50? That's the kind of thing you look for to say, okay, we're starting again. We're starting a new intermediate trend again. The near-term situation is starting to look better at that point after the strong sell-off. So, and again, to meet the average move after such a large decline over a period of a week, from what we've seen in the recent past, that's not a very big move. But considering where volatility is, it might be a little bit of a roller coaster, even if we do finish the week on the higher end this week. So, which would be the expectations again for the things that we've talked about before. So that's what I'm seeing based on the charts here. What do you think? Do you agree with that? Do you disagree with that? Click that link right there in the top right corner of your screen, opens up the poll, and then click an answer. If you click on disagree, scroll to the bottom of the page in the comment section. Want to see your comments, want to see what you're seeing that would suggest maybe we are more bearish, because there's a lot of people out there that are suggesting that we wouldn't buy stocks right now, that this is it, right? This is the start of the bear market. So, if you're seeing that too, tell me what it is that you're seeing that would suggest that maybe we should be more bearish than what the market outlook here suggests. So, I'd love to hear your thoughts. Scroll down and comment either on the YouTube channel or on our Market Scholars blog. All right, now let's take a look at what's driving the price action today. And you can see some of our biggest winners today. You can see agricultural commodities are hitting 3-month highs, really, really darn close to a 3-month high today. So they're one of the few asset classes that are actually rallying. You can see gold's also rallying close to its own 3-month highs. Crude oil had pulled back. A little bit of news in that area today, impacting Saudi Arabia, of course. There's gold up there. You can see on the other end of the spectrum, emerging markets, growth stocks, the S&P 500. The dollar was down today. Developed markets, investment grade bonds. There's your S&P value stocks. So everything, all those stocks, asset classes were down except for real estate. Small cap stocks are up today. Preferred stocks. There's your dividend stocks are outpacing the S&P 500. So your kind of individual asset classes all doing very well, relatively speaking. There's MLPs, but remember they had pulled back the most too. So a little bit of an oversold technical bounce, even especially too in gold and agricultural commodities, which have been so beaten up with the dollar moving as it has. If you take a look at the last couple of weeks, here, look at this chart here. So this is the 2-week chart. There's your return in agricultural commodities. Nice strong rally that they've had here to get to 5% gain in 2 weeks. Gold's also bouncing up. On the other end of the spectrum, there's your S&P 500 down here with international stocks and small cap stocks with the biggest loss, down 8.5% in the last 2 weeks. And there's your dollar, which had been strong but pulling back. One thing I did want to show here is the S&P 500 at the end of September was showing a 7.2% return on a 3-year rolling window. Right, this is updated every month. It's off of Y charts here. As of right now, the return for the S&P 500 over the last 3 months, with this decline that we've had, is down to a negative 2%. So depending upon where we finish October, we might get something like we did October 16. I've compared this. That's one of the time frames that has similar technicals to right now, where we had a big decline really quickly in anticipation of, it was right at the very end of October too, but in anticipation of the election, we had a little dip to negatives. You can see the average over long term is 2.2%. So we were pretty high, relatively high compared to what we've seen in the past. We were relatively high, so we pulled back, obviously, with this big return and setting up for the possibility. See, this was February. We were down 6% on a 3-month rolling window during February, March, and April. These two, where we got down 6%, we were down below the 200-day moving average, and of course we weren't there. And then we've also shown you some other times here, especially October of 2014, where there's a little bit of a pullback as well. So those are the kind of things. Are we getting one of these kind of moves, or we're going to really drop sharply, or are we getting the smaller pullbacks that are more representative of what happens when we're above a 200-day moving average, like we are on the 3 of the 4 major indexes? If you take a look now at the major foreign markets out there, of course, they're all looking very similar. They're all showing, Germany's close to 3-month lows, Italy, the UK, France, all these European nations, Japan, China, South Korea also near their 3-month lows. India had already been down there, and look at all those clusters on India. Very similar to what we saw with Russia, and look what happened with Russia coming off a lot of clusters like that. Brazil's also had its time where it's had a lot of clusters. So it's actually the biggest winner right now, the only one that shows a green chart, Brazil. It was down today, and you can see China and Korea down, underperforming the S&P 500. But all the European and Canada has been down quite a bit too, in sympathy with the U.S., but all right now, really, your top performers are Russia, because it's at 60, and Brazil at 83. Everything else has got really low intermediate lines, all below 20. Japan almost, but everything else strongly below 20. So, we've had a broad sell-off, not just here in the U.S. And remember, all these other nations had sold off previously without the U.S. You finally get the U.S. joining in. So a broad sell-off all across the board. Again, the more broad a sell-off is, the more likely you are to find buyers looking for cheap assets across all these different countries. Lots of opportunity here. Whether the dollar is bullish, which would be beneficial for the U.S. stock market relative to all these areas, or if the dollar ends up turning down and being bearish, you'll have a lot of opportunities in a lot of these foreign areas as well that have been so beaten up. Emerging markets and developed markets. Again, real estate has really been beaten up with the mortgage rates rising, with yields rising, especially the 10-year yield. So they have bounced up. Real estate's down here. You can see a lot of these sectors showing clusters really beaten up. Staples bouncing up a little bit more than others. Today it's got a better looking chart. Utilities has got a better, it's got one of the higher intermediate lines out of all of these. All the rest of them all below 20. So again, another one of those situations where you have a pretty broad selling. Even energy, which has been one of the stronger ones, has pulled down those 3-month lows. Healthcare is not down the 3-month lows, but it's pulled back well below its moving average. So broad selling gives opportunity for all of this to bounce right before that sector rotation takes hold again, and the areas we expect to outperform, like energy, like materials, like industrials, will start to do so. Today, technology, energy, financials all lagging behind. So you can see it really wasn't a one storyline today. It was still kind of a lot of volatility that you're seeing in stocks coming out of last week, heading into a very important week for a big basket of earnings coming out. So lately we've been focused on taking advantage of this sell-off to do some bullish trades. Of course, if you want to maintain some balance in an active trading portfolio, we can look at the flip side of the coin too. To throw a bearish trade in there, you can see one of the stocks in the energy sector that's really dropping, and kind of, again, everything else was really small candles today, but not this one. This stock down 4%, breaking below its lows, breaking out of a volume support area into this vacuum of support until you get down to about the 90s. Below 95 is where the next major level of volume support is. So you can say, okay, well, there's a bearish opportunity we can take advantage of. Dropping below the lower Bollinger Band, you can see its market forecast chart showing strong bearish posture. Again, kind of the oversold cluster, but in this case, it's like similar to this one where you get an oversold cluster kind of on a breakdown that could lead to more selling, especially considering the posture just turned bearish after being bullish right here. If you take a look at the long-term chart for VLO, you can see that it's still not broken its 200-day moving average. So getting down below that level, getting down to below 100 into these 90s where this next layer of support is, would be a big breakdown of support. And you can see we saw the Bollinger Bands, and they're suggesting more weakness. The DI negative line crossing above 25. The ADX suggests that there could be an extended run. See, when you get the ADX rising up above 20, then you can get the extended runs. In this case, with extended bullish runs on both of these. But you'd expect, okay, if it rises above 20 here, you get an extended run to the downside. Wouldn't last as long because downsides aren't as long, but you get it deep enough to where we might get a decent run. Now, we can say, okay, well, I could buy a put. I can buy an at-the-money put here in November, expiring in 32 days, and then offset some of the costs with this short put at 100. That caps my gains as well. So it gives me a $279 potential reward for a $220 risk level. And then we can position size around that, and it gives us about a 50% odds. And you can see this, there's the support we just broke. There's our break even. So we'd have to get below that level to eventually break even on the trade, and obviously get below 100 to make the maximum gain. Knowing that if we were to break up above 110, so back into this area, you probably don't need to stay in the trade any longer. So you'll probably end up losing about half, a little more than half of what you would be position size to lose. So you get a decent reward to risk ratio if it continues lower, and if we get out upon any breakout back up above that 110 level. Alright, so that wraps us up for today. Thank you as always for watching our Market Outlook video tonight. Remember to subscribe to our YouTube channel, click the thumbs up icon down there, and comment. I want to hear from you and see what you think about the markets right now. What do you think about this trade idea on Valero? What do you think about what's driving this price action? Was there any questions you had or comments on anything I didn't discuss? Make sure you put those in the comment section as well. Remember also to follow me on Twitter for stuff that I share throughout the day, throughout the week, as well as join our Market Outlook community of a bunch of people like you that are watching these videos day in and day out on Facebook, as well as on our website at marketscholars.com. You can join there for free. So as always, again, thank you for watching. Have a great rest of your evening, and we'll see you all tomorrow.